Hi, everyone. Welcome back to the SoFlo Real Estate Show, your go to source for the latest insight in South Florida's dynamic property market. I'm Athena Barrocas. I'm your go to Weston and South Florida Realtor. I have John Cannon, our expert mortgage consultant, here with me today. We're going to dive into the crucial topic for all prospective home buyers in South Florida: how to avoid the 7 home buying mistake in 2025's shifting market. If this is your first time in the show, go ahead, check the box, subscribe, and that way you'll have all the latest information on the real estate market. Welcome back to Welcome back to Ask Athena Anything, your trusted source for insights in the South Florida market. I'm Athena, your local realtor, and we're diving into the 7 home buying mistakes that you're going to want to avoid in today's 2025 shifting market. Let me introduce you to my co-host, John Cannon of Wintrust Bank. Tell us a little bit about yourself, John. I'm so happy you're here.
Well, thank you, Athena. I'm happy to be here. And Wintrust Mortgage, the number one thing that I would say is it's a 50-state lender. So wherever you're watching this, I can help you with a loan. And of course, if you're in South Florida, Athena will take care of the real estate part of it. But I've been doing this for 22, 23 years. Been with Wintrust for 7. And Athena and I met when she was helping my realtor sell my house in the Bay Area 10 years ago. Athena, can you believe it was 10 years ago? In fact, it was Kentucky Derby weekend.
Was
10
it
years
really
ago.
Kentucky Derby
Yeah, because
weekend? Oh my gosh.
my family, we decamped to a Residence Inn because you guys like, get out of here. And so we went and hung out at a Residence Inn. We watched the Kentucky Derby.
That is
So,
a great memory, John.
yeah,
That is a great
yeah.
memory.
It's
But
hard to
I have
believe it's been that long.
It is that long. And gosh, that's a decade. But you know what I
Yeah,
have to say is when you have that kind of relationship, both personal and business, boy, oh boy, don't you feel comfortable in recommending and referring somebody that's going to help your client do what they need to do to get the best for them and to get them across that finish line stress free?
absolutely. And we can flip it around. I've been fortunate enough to do a couple of loans for you with your properties in California. And so we have both taken care of each other. And so I'm very happy to be here today to do this with you.
Well, I'm happy to have you here today, John. So before we get started, though, I know that we agree that there is so much confusion out there in that marketplace. We have lots of chatter coming in from social media, and what it's really doing is halting buyers from buying their dream home. It's putting them right back out there on that fence, and they're watching for something to happen. I don't know what they're watching for, but they're watching for something to happen. And I like to discuss maybe 3 of the current market issues that are really
Okay.
impacting the buyers and how we can help them get off that fence.
Okay, let's do it.
Okay, let's do it. First of all, let's talk about the first thing that's holding them back, and that's the current market and what's going on as far as affordability. Affordability, we're hearing all over the place. What are your thoughts on affordability, John?
Well, it's a challenge. And it's challenged because interest rates are higher than we're all used to, but they're not making prices go down. I mean, if they really, historically, that's kind of how it's worked. If interest rates were higher, then it would hurt prices and prices would go down. And so that affordability would kind of find a middle ground. And that's not really happening right now. Prices are steady and yet rates are increased. And so I wish I could tell you that was going to get better, but we don't know. I mean, the rates could go higher from here. And I really think it's important for people to look at a particular house right now and the rate and the payment that they would have and understand this could be their last bite at the apple, at that price, certainly. And I know later we're going to talk about sometimes people who have waited too long and it's cost them big money. But that if they really need to evaluate this transaction, what it's going to do for them, how it's going to affect their budget, do all that stuff, and realize that if it's a go, if you can do it and you like the house, then probably it's a good idea to pull the trigger. Because if you wait, the house could be gone, the rate could be higher, the price could be higher, and then when you do that math, the next time it won't work out.
No, you're absolutely right. One of the differences in today's market is if we look back, you and I have so many years in this industry, we can look back, right? If we look back in time, one of the things that homeowners really didn't have was this equity. We had the unicorn years following the pandemic, And across the nation, homes appreciated 30 to 40, 45% overnight, it seemed like, right? So now homeowners have this huge amount of equity. And that's also contributing to the fact that, we're not seeing a lot of movement right now as far as, the homes going on the market and buyers being able to buy. And going back to your statement that, the interest rate and home prices would have adjusted. We're just not seeing that anytime in the future. I can't find one report from one credible analyst that's saying we're going to see a huge decrease in price. We're going to see a huge decrease in interest rates. That information is just not out there. Are you seeing
Or
anything different?
we're not going to see an increase in homes on the market either. I mean, that's the other thing is, as you said, people are staying in their homes. They've got a 2.75 interest rate. I'm sorry, I did that. It's my fault. And we knew we were doing it, Athena. We're like, this is going to be a problem at some point when all these people get into these and they get used to that monthly payment, and they don't want to sell that house until they absolutely have to. And so they're holding on to their houses, and that's what's keeping housing prices high, is a lack of available inventory. So, and again, no quick solution to that. And the fact that interest rates are, the Fed came out again yesterday, and they don't have any idea. And folks, when the Fed doesn't have any idea, you know that you're really in uncharted waters, because it's uncharted is what I meant to say. People say uncharted, and it's like, oh, the boat, how'd it get here? It wasn't charted. Charted is when you're in a place that's not mapped. That's where we are right now. And so
Uncharted. Okay.
uncharted territory. Now we know that if tariffs happen, they are inflationary. And so if we see tariffs, we will see inflation. Inflation leads to higher interest rates because the Fed is trying to get inflation lower. And in order to do that, they raise interest rates, because the higher the cost of money is, the less people want to spend it. And that helps inflation come back down. When people are spending money like crazy, inflation goes up because you got a lot of money chasing fewer goods. And what the Fed tries to do is balance that. So the amount of money that's chasing and the amount of goods that are available are roughly the same. And they were kind of getting there until the current administration took over and started talking about tariffs. But the other thing is, because this administration also has a different way of operating than any other one ever, we don't know if they're even going to do what they've said they're going to do, because they do change their minds
Yeah.
sometimes.
Yeah, they
Sometimes in the
do.
same day.
In the
So
same
it makes it
way.
very hard to plan, makes it hard for businesses to plan. That affects, businesses aren't hiring like they were before because they don't know. Will I need these people? Will I not need these people? I don't know. I want to hire a bunch of people and just lay them off. So that's why things are such an unknown right now.
No, absolutely. And that adds to the fear of our customers that we're talking about, the fear of home buyers, right? Are they going to have a job tomorrow? There's a lot of fear and confusion out there. So those are really good points, John. Now, let's talk about the regional disparity in the housing market. Do you see, it says you do lend in 50 states. So you get a nice view of the map of the United States. What are you seeing out there as far as any regional disparity or trends?
Well, we're seeing a nationwide decline in new contracts. People buying houses. They're just, as you said, they're on the fence. And if they weren't on the fence before, they're on it now. And if they were on the fence before, they're maybe off it now on the side of, I'm not going to buy anything, for a while. So that makes it, really a buyer's market, which is a unique opportunity, Athena. When it is a buyer's market, and when that buyer is confident that they're going to have their job and everything is fine, they can really get stuff done in a market like this. They can get sellers to do flips and twists to help them. They can get repairs done, which, in 2021, height of COVID, sellers were like, look, I'll find somebody that doesn't care that door is falling off its hinges. That now, what do you want me to do, Mr. Buyer? Do you want a seller credit? Do you want a credit that goes to a 2-1 buy down to help kind of alleviate this rate concern? Well, what if the seller gave you some money to buy down your rate? That's a tool that a buyer right now has available to them that they just didn't before. And one of the things that buyers have right now that they didn't before, time to think. Because in 2020 and 2021, you didn't have time to think. It was like, you like this house? You like this house? You like this house? Oh, I'm sorry, it's gone. And now you can at least meet with your financial planner and do some things, because that house is probably not flying off the shelf as fast. So those are advantages to sellers right now, and people need to keep that in mind.
Yeah, absolutely. You're talking really about our third issue, which is buyer sentiment. I'm glad we circled right back into it because I don't think there's anything more important in this segment of this episode than talking about the buyer sentiment. And we're seeing that, there is some growing pessimism out there. There's growing concern out there. So I'm going to ask you a question. Is this the right time to buy a home, John?
That is an individual question with an individual answer. And probably more goes into it than might have a year ago or 2 years ago when things were a little less uncertain. If you're in a situation where your choice is to rent or to buy, then I'm always a fan of buying if you can do it. I just think when you rent, especially if you have kids, you give up so much control of your life. You could really like your house where you're renting and the school district and your neighbors. And then the landlord decides, you know what, I'm going to move back into that house. Or my son's finishing college and I want him to move into that house. Or we decided we're going to sell that house. And maybe you're not prepared at that moment to buy that house. And all of a sudden you're moving, you're maybe changing school districts. I mean, there's a lot of stuff that when you're renting, if you're young and right out of school and don't have any kids, then that's one thing. But if you've got a family and you can buy, then I think the favor is to buy. Real estate is undefeated, Athena. Over the course of U.S. history, there have only been a couple of times in the last 50 years where real estate lost money year over year. Just a couple of times. If you are in a position where you don't have to sell right now, sometimes if you have to sell and the time's not right, or you haven't been there long enough to build up any equity, then real estate can be painful. But if you are in a situation where you know you're going to live in a place for a while and you have time, then buying real estate is absolutely the way to go. So to answer to your question, it's always a time to buy if those factors are in place and if you're confident about your job and your income and you find a good neighborhood and a good school district, always a time to buy.
I agree, John. There's a lot of ifs in your statement, but isn't that part of life, right? If there's
Yeah.
always ifs. And the best thing you can do if for our audience out there, a home buyer sitting on the fence, not sure if you want to let go, talk to a realtor, talk to a mortgage broker, talk to somebody in the industry that's going to be open and honest and tell you the truth. And then develop a strategy. And if you like where it's going, great. And if you don't like, get back on the fence and wait for a different time. But today, in this buyer's market, in a time where the interest rate may be lowest that it has been and going to be in a while, because who knows what it's going to look like in 2 years, housing prices are, they're evening out, but they're not dropping, right? So the market's not going to become less expensive in the future. It's always going to be more expensive in the future, to John's point. So
And Athena, the one thing we do know, when rates go down, all of these people who have been waiting, they're all going to jump in at the same time. And what will that do to housing prices?
oh, it only goes one way, it goes right up.
They will go up, up, up. And so you could be waiting for a lower rate and you could get a lower rate. But because your house price went up 20% while you were waiting for that rate drop, your monthly payment could wind up being higher anyway. And you can refinance the rate. You can't refinance your house price. What you buy your house for, that's your price. And that will matter when you sell your house. The rate you have, you can refinance. And first time homebuyers may not even know this at the end, but you can get a new loan if rates get lower. You're locked for 30 years. If rates go up, don't worry about it. But if rates go down, your lender can get you a new loan. There are costs involved, but can get you a new loan at a lower rate. And you'll have that rate for 30 years unless rates go down. And Athena and I have both been in this long enough where there are cycles where I've done 2 or 3 loans for the same borrower over the course of 2 years because rates kept going down that much that even with the costs involved, they'd save them in 3 or 4 months of the lower payment. They'd have their costs covered and they'd be in good shape. So the rate is not a reason not to buy the house unless it keeps you from being able to qualify, in which case there's nothing you can do. But if you're choosing, and I've had buyers, Athena, who've done this, it's just, you know what, I don't want to pay 7%. I just don't. Okay, but that's the rate right now, and you're passing up a chance to buy this piece of real estate that would solve a lot of your problems. It's ticking off all your boxes, but you don't like the rate, even though you could refinance the rate if rates go down. And if you're saying to me, I'll buy when rates go down, then you believe rates are going to go down. And if you believe that, then buying now with the plan to refinance when rates go down is a very solid strategy, unless you don't think rates are ever going to go down again. And that's a reason to buy right now. I mean, it just, if you feel like it keeps coming back to there's a reason to buy, it's because Athena and I have both seen a lot of people change their lives for the better simply by buying a house. And then I come back to them 2 years, 3 years, 5 years later to refinance the house, and their financial situation is completely different than it was when they bought the house. And it's because they bought a house.
Absolutely true, John. Absolutely true. And that's why, sentiment is so important. So, we understand everybody has feelings around it, the rates and the housing prices, but we're here to really help you build a strategy so that way your dream of home ownership can come true. So, John, thank you for discussing those challenges with me and with the audience. Your insight is invaluable. So, thank you. What I'd like to do now is move on to the common mistakes. When you're buying, there's so many mistakes you can make out there, and they're very impactful. There's a lot, but John and I narrowed it down to the top seven, and we want to dive into these top seven because as a home buyer, when you're making a decision to go into the loan process, there's a lot of rules around, staying worthy of the loan. So we just didn't want to we wanted to make sure that we dived into these. So the first one is, John, I'm going to name it off and I want you to give me, your thoughts on it. Is not securing a pre-approval. Tell me about this.
Well, that's that's a mistake, and it's not just if you have a realtor that you've decided you're going to work with, and they have not insisted that you have a pre-approval, then you might have a realtor that's inexperienced, or you might just have one that doesn't value their own time, so they're not busy and they're willing to drive you around having no idea if you can qualify for a house. So getting pre-approved is the best way to know not only that you can qualify, but what you would qualify for. And remember, if I give you a qualification for $550,000, it doesn't mean you have to buy a house for $550,000. You can choose. It means you can't buy one above that, as things are currently set up. But it is so much better because there could be things on your credit report. If you haven't had a credit report run in a while, there could be things on there that are wrong, and we need time to fix them. And if you don't get your credit report till after you find your house, then you're really under the gun. So it's much better to get that done ahead of time and make sure everything works out. And so that is a common mistake, and it's surprising, but I think it's because there are so many new realtors. I mean, how many people join the real estate ranks every day, Athena? And they're free to grab somebody that they know from church and go take them out, to show them houses. So if someone tries to get you out to see houses and you have not gotten together with a loan person and shared your pay stubs, your bank statements, you got to do all this. You got to have a credit report run. These are all things that go into that. If you haven't done all that, then you're really not ready to look at a house.
Absolutely agreed upon. I have to tell you, John, there are a lot of buyers out there that do believe that they can just go out and look at homes and then do this afterwards. However, it's very dangerous for them because they can find a house they absolutely love, right? Absolutely love. It ticks all the boxes. They've been looking for 6 months, a year, and then what? Something comes up in their credit report, and you, as a loan officer, go, "Oh, we have to stop and we have to fix this." Well, while you're fixing it, which you must fix, what happens to their dream home? It gets bought by somebody else, right? We don't want to see that happen. We want to make sure you are positioned with the power of strength on your side and that your loan officer, such as John, has looked at your taxes, has looked at your credit report, has looked at your pay stubs, has looked at everything. So that way you are fully prepared to buy a home and your realtor can go ahead and negotiate on your behalf because you are so prepared. So having that pre-approval is a must. And to John's point, if anybody puts you on a card to go show you a home without a pre-approval, jump out because You really need to have that
Yeah.
strategy. It's a must. After 20 some odd years on my side, 20 some odd years on John's side, it's a must to be pre-approved and have a proper strategy before you move forward.
And a credit report, Athena,
Yep.
lasts 120 days. So
Okay.
once you get it, you have plenty of time. And the other thing is that whenever we run a credit report, at least with my company, we also get a path to improving the credit score. It can be paying down a credit card. It can be as simple as you're an authorized user on someone else's account that doesn't have good credit, and that is dragging you. You're not using that card, but you're an author. So just getting your name off of somebody's card can be a big help, or getting your name on somebody's card. If you got a spouse situation and one of the cards is in only one member of the family, and so the other one, because we always take the lower of the two credit scores when we're qualifying. So if one's got really good credit and one has so-so credit, sometimes we can, by adding the person as an authorized user, it brings up their credit score. So these are things that take time, and you don't want to start this process when you've already found the home that you love.
Great point, John. Thank you for that extra piece of clarification. That was really good. And let's move on to the second mistake. The second mistake is not understanding the true cost of buying a home. There's the purchase price, right? And then there's closing costs, there's inspections, there's insurance, there's potential repairs. I always tell my clients, as a rule of thumb, you need to plan for 3 to 5% cash in addition to your initial deposit in order for closing costs, right? So if you're buying a home for 700,000, 5% of that is 35,000 for closing costs in addition to the deposit. So, this is the way we look at it when as a realtor to kind of give that rule of thumb. But you as a lender, John, you go into a little bit more in depth. Tell us about how you would look at the actual cost of closing.
Okay, well, one thing is that the loan officer should be able to tell you with pretty good certainty what your closing costs are going to be. And there are two different kinds. There are recurring and non-recurring closing costs. The non-recurring are costs of the loan that you only do this when you buy a house. That's title insurance and the appraisal and the lender's fee and any points that you decide to pay to lower down the rate. Those are one-time costs. But when you close, when you buy a house, you also pay insurance, which you're going to pay you're going to pay it once a year. But if you get escrows, which most people do these days, they pay for their taxes and insurance in their house payment. And in order to set up a fund that we can do that out of, you're going to pay a few months of taxes and insurance at closing. And so we go through that, let people know that. Also, they're going to pay interest. If you close on the 5th of the month, you're going to pay 24 or 25 days of interest at closing. And then you're not going to have a payment at the end of that month. Your first payment is going to be the end of the following month. These are things your lender should be sitting down with you. It shouldn't be a loose, it's going to be about this much. I mean, those are things that we really should be able to tell you what the non-recurring closing costs, very close to what they're going to be. The recurring closing costs, taxes and interest, it depends on when you close, so it's a little looser, but still a good idea of that. But then you're going to need a hose or two. You're going to need stuff. You have no idea what you're going to need till you get into the house. So that's where what Athena's talking about is have some, because the lenders don't require reserves on conforming loans. So you're on your own to do this. Have some money for those trips to Home Depot, those trips to the grocery store to get your home set up the way you want it is going to cost money.
Absolutely. That really goes right back into poor budgeting, right? Um, you know, Homeowners really don't know, as you said, how do they budget? Well, you have to have reserves. It's just a rainy day. The rainy day account. When you and I grew up, John, we always talk, where's your rainy day account, right? For those things that you would need to do. So I get a hole in the roof, a window breaks, a pipe bursts. What is it that you need? Pavers are not even anymore. You need to do some landscaping. A palm tree needs trimming. These are all things that you don't plan for, but you should have an account ready to go. That's your rainy day account. I don't know, John. What do you think is a good amount of money for a rainy day account if you were to start
Well,
over?
I think that if someone has like 3 months of their mortgage payment in the bank, it's unlikely that you'd have an episode where you couldn't make your mortgage payment for 3 whole months. but you could use that money to do these one-time costs that Athena is talking about, and then you've got to replace it. You've got to, and that's why, again, budgeting, and you don't want to buy a house where every month, every dollar that comes in is going to be going out somewhere, because you need to build up these savings accounts for things like that. And then also home warranty. Athena, I don't know, we haven't talked about this, but I've used my home warranty, and I've got a house that's, built in 2000. It's not like, super old. I've our garage door, we had a refrigerator that we had to have repaired a number of times, and the home warranty was a huge help. So they cost now $600 or $700 a year, but you pay a trip cost when somebody comes out to fix something, instead of paying that person's hourly and the parts and the labor and everything else. So that's something that you want to talk about with your agent, but that's something I really recommend.
That's a great budgeting item. I know I love home warranties. I give a home warranty to every one of my buyers that close because it's just a nice thing. One, it's a nice thing to do.
Yeah.
But secondly, I'm hoping that they will continue on with the home warranty every year. So it goes right back into budgeting. Let's talk about the fourth biggest mistake, picking the wrong neighborhood. Research is key, and home buyers need to consider factors like schools, shopping, amenities, future developments in the area, but also lifestyles, commute to work, time to the airport if somebody travels a lot for work, or recreational activities in the area. So John, what are some of your thoughts on buying a home that doesn't fit the location perfectly? What is the mistake around?
Well, I think that one of the things that people can do to keep from making a mistake like that is visit the area often and do it at different times of the day. Go at night and sit in your car parked, across the street and down the block from the house, and roll your windows down and just sit and get an idea, what's the ambiance here at night? What is the vibe? And that's also when you'll see if there's activity going on at night that is not favorable. You'll see that. Obviously, a nicer neighborhood costs more money. And there are times when you really don't have that ability right now. So you got to pick the best home you can afford, which, well, let's all agree those are not going to be in the best neighborhoods, but one might be better than another, even in that price range. And when you are close to a good school, but not like right close to the school, speaking of noise, then you'll always have more resale value. That house will always sell better if it's close to a school. And so that's what you really want to remember when you're buying a house for yourself to live in. And this is different than if you're an investor. If you're buying a house for yourself to live in, you have to think about what's it going to be like to sell it. And really, that is the same really for an investor too, because they're eventually they're going to sell their house, and investors have to rent their houses maybe every 2 or 3 or 4 years. So if you have kind of a weird house, let's say, and maybe there was work done to it where they added some stuff on, and it's just kind of a little funky. If you love the funky, then and you know you're going to live there for a while, go ahead and buy the house. But you have to know that when you go to sell that house, you got to find another person that likes that funky, that particular kind, and that can be hard to do. That's why investors don't like houses like that, because they have to rent them often, not just live in it for 20 years and then find one buyer. They have to find renters who are okay with that. So those are things to keep in mind when you're trying to buy a house. But I really can't emphasize enough, listen to that neighborhood at night to get a sense of what's going on.
I like that. That is a great idea. Scope it out. See if it speaks to you during the different times of the day, and go to the different shopping centers and see, the vibe of that area, or the parks. The parks is another great area.
Parks, yeah.
You're right. Infiltrate and just see what it's like, and determine whether or not that's a good fit. Okay, John, let's move over to mistake number 5, lack of urgency. And we talked a little bit about this, but what are your thoughts on, the lack of urgency of buyers today?
Well, what I tell people, Athena, when they're hung up on maybe the seller countered their offer, and so maybe they're going to have to pay $5,000 more than they wanted to, or maybe even more than that. I try to help them get into the headspace of, if they don't get this house, I mean, this house is now, it's there for them to get. Okay, they have an offer back from the seller, and if they say yes, then it's their house. So you want to figure out, okay, what's that extra $5,000 or $10,000 going to cost me a month? That's important. Or If you have the extra money to just put it down, then that solves that problem. But you have to decide that you want to do that. But I want to put them in the headspace of, if they don't get that house, what's going to happen is every house they go to see, they're going to be comparing to that house, and they're not going to find one. Because even maybe what you could say objectively is a better house, but because they saw this other one first, that's the house they're going to compare everything to, and it's going to be really hard to find something. And you may wind up even buying a house and still wishing you had the other house. So you want to try to not let a small amount of money, and believe me, $5,000 to $10,000 sounds like a lot of money, but in the arc of our lives, it's really not. So you want to try to not let that get in the way of you being happy in a place where you could conceivably live, for years and years and years.
That's a good point. We say there's no urgency, but it's really an emotional space. Buyers and sellers get into an emotional space. And it's you and I who, as agents, we try to guide them and help them overcome, some of these challenges that the emotions buy. I had a buyer. I'm going to tell a real story real quick. I had a buyer and they ended up buying 4 years later. All right. The wife, she wanted to buy. I knew her before she was pregnant, while she was pregnant, after she was pregnant. The husband's statement was always, I'm not feeling it. I'm not feeling it. I'm not feeling it. And we would go to houses that were 3 bedrooms with a pool, nice homes, not super updated, affordable, giving them the lifestyle they were wanted. I'm not feeling it. So what do we say? No urgency there, right? I don't know why he didn't want to buy, but he ended up having to do this in order to buy those few years later. He had to get a second job, right? Had to get a second job. They ended up paying not the 2.9 or 2.9%,
Mm-hmm.
but 6.7% in interest rate. The $320 home with a pool, $320,000 home with a pool, ended up being a $600,000 townhome in a great school district. Don't get me wrong; they're very happy there. But I think the point of what we're trying to say is that without the urgency, without the willingness to compromise a little bit, is that you end up buying something, maybe it's not what you had hoped for. It's not your dream home. And to this day, she goes, I really miss having a pool. So I know you
Yeah,
do, but your husband was in my head. I'm going, your husband was like, not feeling it, right? There's nothing we can do
yeah.
to overcome that space. So that is a great point, John.
There is a thing that financial planners tell people, and that is, we all overestimate what we could do or save in a year, and we underestimate what we could do or save in 10 years. And real estate really is the same thing. And your example there of what 4 years did in that real estate market changed everything. And people have to kind of get out of the here and now and think about their future and how quickly 5 years later. You and I were talking at the beginning of this podcast about how quickly 10 years have gone since I moved with my family from the Bay Area. We're here in Iowa now. And I can't believe I still feel new to Iowa, and I've been here 10 years. So you have to, and that house in California that we sold, obviously went, and I'm good with it. They can have that money. I needed to get out of that market. It was killing me. And we got here to Iowa. We bought a nice house, and it's increased in value, and I'm fine with it.
And
But
you're happy, right? You're
and we're
happy. Your
happy. Yeah,
strategy
yeah,
worked out. You are happy doing what you're doing and where you
yeah.
are. So that's,
Right.
and that's the urgency, right? You're doing what you needed to do. So I just want to hope our listeners and our audience really, take heart to that one. Let's move on to hiring number 6 mistake, hiring the wrong realtor or the wrong loan officer. Oof. This is a big one. This is a big one. But what I would like to say is that, whether you're looking at a loan officer or a realtor, you need to hire somebody who's experienced, who understands the market, who negotiates effectively, and can guide you through the process with honesty and clarification and just truth, and really can develop a strategy that works for you. That is not something that you can just do right out of, loan officer school or real estate school, especially in markets that are difficult, like today's market. We have a very difficult market. So, John, what are your thoughts on this subject?
Well, first of all, as a buyer, we had a realtor here in Iowa that was referred to us by my wife's job that we were moving to. And he was very experienced realtor. He was probably in his early 70s then. And I will never forget that there was a house that we went back and saw it the second time. And he sat down on the stairs of this house with his iPad. And he was going through stuff and he was and he said, I can't figure out why this house hasn't sold, but there's something. And then finally he looked at the floor plans and he said, that's it. The master bathroom is over the garage, which you folks in Florida don't understand this, but that's an unheated area. And so you got a master bathroom above an unheated part of your house. And he said, you will never get that floor warm. And he said, that's why people haven't bought this house. It's one thing for a realtor to say, hey, you know what, I don't think this is the house for you. But for someone to work that hard to figure out why a house hasn't sold so that you don't make the mistake that all these other people are not making, that I was a fan of his for life. I mean, that's what you want in a realtor is someone that will really get into your space and your head and tell you what you don't want. It's more important. Any realtor can say, hey, look how great this house is. It has this and this. And anybody can do that. But for someone to tell you, you know what, you told me you really wanted this, and this house doesn't have that. Now, if you've changed your mind, that's fine. You're the client. But I need you to know that this is not exactly what you told me you're looking for, at the beginning. So I think that's something. And as far as loan officers go, I don't know. I know that obviously experience is very important. The company is important. We can do loans that other people in town can't do. We have a portfolio program. So loans that have a little hair on them, we can do those. I just had a guy who's trying to get out of a timeshare, and the company that's helping him has told him don't pay the timeshare. Well, he's got there's rolling lates on his timeshare, um, and and it's a mortgage. So you have lates on a mortgage, which is ordinarily you're a dead duck. But because it's a timeshare, we're able to move that to an installment loan instead of a mortgage loan. And boom, we could, the hit to his credit wasn't that bad, his credit score. So we're able to do that loan. So he was at another lender in town, ready to go. And then his realtor had him call me and we're doing the loan for him. So there are, if you have a cookie cutter, wonderful situation, you're a W-2 borrower, you got a big down payment, it almost doesn't matter. But if you've got anything a little different, what you really want is somebody who will sit down and talk to you about closing costs, explain recurring and non-recurring closing costs and what they're going to be like, and really involve you in that, and then being available. It drives my wife crazy, but I answer the phone on the weekend, and I answer the phone in the evening. I try not to. I try to, if it's not urgent, I try to move it to the next day. But I'll answer the phone. And there are lenders, particularly people who work at credit unions or they work at places like that. They work at banks. They work 9 to 5. And you really don't want a mortgage lender who works 9 to 5 because something will happen on a weekend at some point, and you'll need
Absolutely.
help.
John, it's in our industry, but you won't find a good realtor that's going to tell their client, try calling your loan officer on a Saturday at 3 o'clock. If they pick up, it's a good loan officer to consider. If they don't pick up, no. And the reason is because transactions occur on the weekend. And as a realtor,
Yeah.
I need a partner that's going to be there, that's going to answer the phone, that's going to rewrite the approval, that's going to re-examine something that can be tweaked in order for the buyer to be able to buy the home. So we can't wait till that day.
Yeah. So the guy in Costco whose cart is over to the side and he's just talking on the phone and he hasn't gone anywhere or bought anything in 15 minutes, that's a mortgage guy who got a phone call at 2 o'clock on Saturday while he was at Costco, and he's going to be late getting home.
Absolutely. And you know what? That's what we do in our industry, and that's what we do for our clients. So I love it. The other thing I want to do is mistake number 7. And I think this is a doozy. And I love the fact that you and I picked this one out, John. It's not thinking long term. This was yours. So tell me a little bit about why this one was important to you.
Well, as I said, we underestimate the power of time and how fast it goes, but how much it can do in terms of appreciation in real estate, appreciation in your accounts, in your stock accounts, or whatever you're doing. And time is money. And long term, you have to think about that. You have to think about how old are my kids? When are they going off to college if they're going off to college? And when will I not need this house anymore? that has 4 bedrooms, and what are my needs? That really is a long-term discussion. And with the rate, I mean, there are really good 7-year ARMs right now, which we haven't had 7-year ARMs on conforming loans in years and years and years. We've had them on jumbo loans, but we haven't had them on regular, conforming loans, which are loans right now under, I don't know, 780 or something. When I got into the business, the conforming loan limit was 322, and now it's 700 and something. So that tells you I've been around a while. But anyway, a 7-year loan could be perfect for you. That could align very well with your time frame, depending on how old your kids are, or how close you are to retirement age, or other things like it. But if you're starting out and your kids are young and your school district's right there, and you think I'm going to be in this house for a long time, then I wouldn't go with the 7-year ARM, even though we could refinance it if rates go down. But what if they don't? We just don't know. So let's get you a 30-year fixed in that situation. Try to reduce the rate down the road if we can, but I don't want you messing around with that if you think you're going to be long-term in the house. So those are all conversations you need to have with your loan person.
Absolutely. And it goes right back to how we started this conversation, John, is that building a strategy that fits your unique situation is so important. And you have to build it with your realtor and you have to build it with your loan officer. And the three of us are a team because without the loan officer, without the realtor, and without you, you're not going to go anywhere. So it's really important that you create a team that you're comfortable with. Hey, John, you ready to do some FAQs?
Sure.
All right, here we go. We have 5 FAQs that came through, and I'm going to read the question, and then you're going to give the answer as our expert guest here today.
Expert witness. Okay.
Expert witness, here we go. All right. What is the difference between a pre-qualification and a pre-approval?
Okay. Pre-qualification is the next thing to worthless. A pre-approval means that a loan officer like me has looked at all your stuff. We've looked at your W-2s and your pay stubs and your bank statements. We know there are three legs of the stool for buying a house. Credit, number 1, income, number 2, and assets, down payment, number 3. And we have looked at all those. We know we got a stool that you can actually sit on. If you have 2 really long legs and one that's really short, you can't sit on that stool. A pre-approval means we've got that figured out. A pre-qualification means, yeah, you know what, that guy looks all right. You can buy a house.
Okay, well, piggyback on here is number 2. How much should I save for a down payment?
Well, again, different horses for different courses, Athena, and 20% is the amount that you no longer pay mortgage insurance. But I run into very few people right now who have 20%, especially first-time homebuyers. And if you wait till you have 20%, you wind up chasing your tail because prices keep going up. The 20% keeps getting larger, and a lot of times you'll never get there unless you hit the lottery. And I don't recommend that you play the lottery. You can buy a house if you're a first-time home buyer for 3% down payment. Now you're going to have mortgage insurance on that payment, and that is something that backstops the lender. If you wind up going upside down and you can't pay off that house and it gets foreclosed on, mortgage insurance means the lender will get some of their money back, which they wouldn't otherwise. And you are going to pay for that policy for them to have that. I have a lot of clients that put 3% down, and we have down payment assistance plans where they wind up paying no money down. They get a second loan from, we have one through the Iowa Finance Authority and one through the Chicago Federal Home Loan Bank, where the second loan, it's a 0 interest loan. You don't have to pay it until you sell the house or refinance the house. And it gives you the 3% down plus another 1% for closing costs. And I've had people be able to buy that house, and in 5 years, they have equity in a house, and they're not at 3% anymore. Now they're at 20%. But if they waited to be 20%, it might have never happened. Save as much as you can, but don't be afraid to buy a house with less than 20% down.
Wonderful. Thank you, John. What are the closing costs and how much should I expect to pay? I know we covered this a little bit, but
Right.
rule of thumb, give us the rule of thumb for this one.
Okay. Now, first of all, the non-recurring closing costs, which are the ones that are one-time costs that you're just going to get when you get your house, you're going to pay these. And they are appraisal, usually around $500 to $600. But if you're in a really expensive area or really big houses, then it could be $1,000. I've had places in the Bay Area where it was over $1,000 for an appraisal. So, but again, first-time home buyer, likely your appraisal is going to be in the $500 to $600 range. The lender fees, we charge about $1,200 for loans here in Iowa. I think we charge about $1,600 for loans in some other states. Florida is probably one of them. But that's a fixed cost. It doesn't matter what your purchase price is. That's a fixed cost. It's not a percentage of anything. And then title and escrow really do vary by where you are. Title fees in Florida are pretty high. I've done some loans down there, and they're pretty high. But your local loan person will be able to tell you the title and escrow fees, and those are your one-time fees of the loan. As we mentioned, you are also going to pay the interest on your loan from the day you close to the end of that month. If you close on the 28th, well, that's going to be a small number. If you close on the 2nd, it's going to be a big number. And then just so you know, you will not have rent is paid upfront. Mortgage interest is paid at the end of the month. It's called in arrears. And it means that on August 1st, you're going to make a payment that's going to cover July's interest, where in rent, August 1st, you pay August's rent. So when you close a loan on the 15th of July, you pay your July interest from the 15th to the 1st, and then you don't pay your August interest until the end of August. And that mortgage payments are always due. They're due on the 1st, but there's a grace period of 15 days. So that you're really not going to pay until August 15th. And that gives you time to kind of catch up and do the Home Depot things and stuff that you need to do when you first buy a house. And taxes and insurance, you got to find out, get a good home insurance quote and then property taxes are a matter of public record. So your realtor can usually tell you what those are going to be, but you're going to pay some of that at closing. Also, you're going to pay probably 3 months of taxes and 3 months of your homeowner's insurance at closing as well. So it depends on how big your house purchase is. It depends on how high your rate is. So we can't really tell you exactly what closing costs are, but I think they'd be in the $3,000 to $5,000 for the non-recurring, and then the recurring closing costs are going to be just really dependent upon your area. But you want to, if your realtor can get you a seller credit, and again, in this market where it's really a buyer's market now, there are not that many buyers out there. Your seller might be able to get you $3,000 or $5,000 from, or your realtor might be able to get you $3,000 or $5,000 from the seller to help you with those closings.
Perfect. Thank you, John. All right, here's a good one. And this is really quite relevant. So I love this question. Can I buy a home with a student loan debt?
Yes, you can. And what we have done in the past is, this is extremely relevant and topical question for this date. And if you're watching this in a year from now, today's date is May 9th of 2025. So it was recently announced that the federal government is going to be much less lenient with student loans than they have been. We had people who were in deferment on student loans, and we were able to take 0.5% of their student loan amount. So on a $10,000 student loan, 1% of that is $100, and half of that is $50. We were able to put $50 in that as a payment for qualifying. I think now people are going to have a real payment. The deferments are going to be ending, and those real payments are not going to be. In the past, they had what they call income adjusted payments, where if you had lower income, they give you a lower payment on your student loan, and we could use that payment. Now, I think payments are going to be higher on student loans. It will affect the ability to qualify for a loan. So, but as far as the fact it's a student loan, it doesn't matter. It's any loan, any debt that you have that you pay monthly is going to go into your debt to income calculation that we're going to do. But now the student loans are going to be a little harder to work with than they have been in the past.
Perfect. Thank you, John. FAQ number 5. Should I lock in my mortgage rate? I guess the question really is, when do I lock in my mortgage rate, right?
Well, my bias has always been to lock if you like the rate, if you can live with the rate, because I've seen a lot of people try to play beat the bank and get the rate might go down tomorrow. What happens if it goes down tomorrow or the next day? And it's really hard to play beat the bank. And here's the rationale that I use. I used to live in Las Vegas. For 3 months, I lived in Las Vegas. My very first radio announcing job was in Las Vegas. And I was in a casino, and I had a good day. And I realized that having a bad day, I could lose $50 in a casino, and it would affect my life a lot more than winning $200 or $800. And winning $800 didn't make losing $50 any easier. And it's kind of the same with trying to play beat the bank. If you have an interest rate of 6.5 that's quoted to you, and you're like, nah, I think it's going to go down, and it goes up instead, and now you wind up locking at 6.625 or 6.75. Every month that you make that payment is going to grind your gears. If you beat the bank, if you're successful and you do get it for 6.375, you'll forget that in 2 weeks. It just the loss of that and the extra money that you're giving the bank that you didn't have to, it hurts so much more to lose than it feels good to win. So it's kind of a long-winded answer to that question, but I think you always lock. We don't know the bottom, and this is true in prices too, Athena. We don't know the bottom till it's.
Oh yeah,
But if rates
100%.
are going down, we don't know it's hit its bottom until it starts to go back up.
Yeah,
So
it's true.
I worked for a guy once who said, trying to catch interest rates at their low is like trying to catch a falling knife. It's really dangerous.
Yeah,
I think you just lock your rate and you forget about it.
I like that, John. I do.
Just
Well,
go
your
forward.
expertise in this area has been phenomenal. One final question, and this is just a one sentence, give it to them straight. What is the golden nugget that you would like our audience to take away today?
When rates go down, prices are going to go up. I
Okay.
think that's the most important thing. People who are waiting for rates to go down need to understand they're not the only one who is doing that. Millions of people around the country are waiting for rates to go down. Even like in October, they kind of started to, and we were flooded with purchase applications, refi applications. I mean, and then it turned right around and went back up. So if you're waiting for rates to go down, that's a fool's errand. It really is. You need to either come to grips with where things are right now, or just decide that you're not a home buyer, and which is okay. But don't wait for rates to go down if you think it's going to save you money. It won't.
Awesome advice, John. Thank you so much for joining us on the show today. I truly enjoyed your expertise and your collaboration today. Thank you.
Well, thank you for asking me, Athena. I'm a little disappointed that you've been doing this for 2 years and this is my first appearance, but I hope I
You
did
come
well
in as
enough
a
to get
stage.
asked back again.
Oh my God.
Yeah.
But I also want to thank our listeners for tuning in to Ask Athena Anything. And if you have any further questions or need some assistance in your home buying journey, reach out. I'm going to put all of our contact information into the description below, or you can simply book an appointment. So happy house hunting until next time. Again, John, thank you so much.
Thank you, Athena. Enjoyed it very much.